$638 billion. That's how much signed business Oracle is sitting on. Record revenue. Record backlog. And yet the stock has crashed more than 60% from its peak, hitting a 52-week low this week. Wall Street is asking one question: is Oracle the cheapest AI stock on the market, or a debt bomb in disguise? Here's the full story. And if you like daily deep dives, subscribe now. 1977. Silicon Valley. Larry Ellison and two friends, Bob Miner and Ed Oates, start a company with just $2,000. Their first client, the CIA. The project's code name? Oracle. Ellison had read an IBM research paper describing a new way to organize data, called a relational database. IBM sat on the idea. Ellison didn't. In 1979, they shipped the world's first commercial SQL database. They called it version 2, because nobody buys version 1. Corporate America lined up. Banks, airlines, governments, everyone needed a place to keep their data. In March 1986, Oracle went public, one day before Microsoft. For the next 3 decades, almost every large company on Earth ran on an Oracle database. But in 1990, Oracle nearly died. Salespeople had been booking revenue that didn't exist yet. Earnings were restated, the stock collapsed 80%, and Oracle came within weeks of bankruptcy. Ellison fired much of his management team and rebuilt the company around discipline. It survived, then thrived. Keep that crisis in mind, because the fear haunting Oracle's stock today rhymes with it: promised money that hasn't arrived yet. Oracle then grew by swallowing rivals. PeopleSoft. Siebel. BEA. In 2010, it bought Sun Microsystems for $7.4 billion, and with it Java, the language running on billions of devices. In 2016, NetSuite for $9.3 billion. In 2022, health records giant Cerner for $28 billion. More than 150 acquisitions turned a database vendor into a full enterprise software empire. So what does Oracle sell today? 3 things. First, the classic database that still runs banks and governments. Second, cloud applications, subscription software for finance, HR, and hospitals. And third, the newest leg, renting out raw computing power. For years this was a steady, boring, recurring revenue business, exactly what Wall Street loves. Then the third leg suddenly became the entire story. When the AI boom exploded, every AI lab needed one thing: massive computing power. Oracle made its bet. Buy hundreds of thousands of NVIDIA chips, build gigawatt-scale data centers, and rent that muscle out. Become the landlord of the AI gold rush. That business, Oracle Cloud Infrastructure, grew 77% last fiscal year. In the latest quarter, it grew 93%. Demand is not the problem. Let's talk numbers. Fiscal 2026, which ended in May, total revenue $67.4 billion, up 17%. Total cloud revenue, $34 billion, up 39%. The fourth quarter ran even hotter, $19.2 billion in revenue, up 21%, and earnings beat estimates. GPU utilization hit 97.5%. Oracle is selling essentially every hour of computing it can build. But here's the twist. Operating cash flow was a record $32 billion, up 54%. Free cash flow? Negative $23.7 billion. Why? Oracle poured $55.7 billion into capital spending, more than 2.5 times the year before, building data centers as fast as concrete can dry. And next year it plans up to $95 billion more. Oracle is betting the whole company on AI demand. Now, the number that started everything. Remaining performance obligations, contracts signed but not yet delivered, hit $638 billion, up more than 360% in 1 year. In the fourth quarter alone, Oracle signed $67 billion in new AI deals. But read the fine print. Only about 12% of that backlog becomes revenue in the next 12 months. The rest stretches years into the future, and depends on customers still being able to pay. The biggest customer behind that backlog, OpenAI. In January 2025, Oracle stood with OpenAI and SoftBank at the White House to announce Stargate AI super data centers across America. By summer, Oracle and OpenAI had signed a deal reported at over $300 billion for 4.5 gigawatts of computing power. That's roughly the output of 4 nuclear power plants, dedicated to a single customer. Running this bet is a brand new leadership team. In September 2025, Oracle named 2 co-CEOs, Clay McGork, the engineer who built the cloud business, and Mike Cecilia, who ran the industry software units. Longtime CEO Safra Catz moved up to executive vice chair. And Larry Ellison, at 81, remains chairman, chief technology officer, and the largest shareholder, owning roughly 40% of Oracle. For a moment, the bet looked like genius. On September 10, 2025, Oracle revealed its exploding backlog, and the stock rocketed 36% in a single day, its best day since 1992. Shares hit an all-time high of $345. Larry Ellison's fortune jumped by roughly $100 billion in hours, briefly making him the richest person on Earth. Oracle was the hottest AI stock alive. Then gravity arrived. From that peak of $345, the stock has slid to around $130, down more than 60%. 25% of the drop came in the first half of 2026 alone. And this week brought a fresh blow, a credit rating downgrade that knocked shares down another 6% in a day. So what exactly is Wall Street afraid of? 3 things. Risk number 1, concentration. Roughly $300 billion of Oracle's backlog, nearly half, comes from one customer, OpenAI. A startup that burns billions every year and has made spending commitments across the industry reported at over $1 trillion, far more than the cash it holds. If OpenAI can't pay, or renegotiates, Oracle's beautiful backlog develops a very large hole. Oracle itself flags this concentration in its own filings. Risk number 2, the balance sheet. Long-term debt has swelled past $120 billion, and Oracle plans roughly $40 billion in fresh financing this year, including selling new stock. Free cash flow is deeply negative. And this week, S&P cut Oracle's credit rating to BBB-, 1 notch above junk status. The bond market has started pricing Oracle less like a software blue chip and more like a leveraged construction project. Risk number 3, margins and the bubble question. Renting out NVIDIA chips is reportedly a thin-margin business. Some reports put gross margins on GPU rentals in the mid-teens, far below Oracle's fat software margins. Meanwhile, parts of the industry have slowed data center plans, and investors openly debate whether AI demand can grow into all this concrete and silicon. If AI spending cools, Oracle is the most leveraged name in the room. Now the bull case. At around $130, Oracle trades at roughly 16 times next year's expected earnings, cheaper than Microsoft, Amazon, or almost any major AI name. Management guides fiscal 2027 revenue to $90 billion, up 34%. And at its Analyst Day, Oracle projected $225 billion in revenue and $21 of earnings per share by 2030. If those numbers land, today's price looks absurdly cheap. So the debate splits cleanly. Bears say the backlog is a promise from customers who may never afford it, funded by debt Oracle can barely carry. Bulls say demand is real, utilization is nearly full, contracts are signed, and the market is punishing Oracle for building the future ahead of schedule. Both sides agree on one thing: the next 2 years of turning backlog into revenue will settle the argument. What should you watch? September 2026, the next earnings report, where the market will stare at one line: how fast backlog converts into revenue. Watch each new Stargate site coming online. Watch OpenAI's funding rounds, because Oracle's fate is now chained to them. Watch Oracle's borrowing costs in the bond market. And watch for new mega customers. Another meta-sized deal would instantly calm the concentration fears. If you want exposure, Oracle trades on the New York Stock Exchange under the ticker ORCL. Most brokers offer fractional shares, so you can start small. Prefer not to pick single stocks? Oracle sits inside every S&P 500 index fund. There's even a modest dividend of 50 cents per quarter while you wait. Just remember, this is a high-conviction, high-controversy stock. Size any position for turbulence. Oracle spent 50 years selling the world's most boring, most reliable product, the database. Now, at 81, Larry Ellison has bet the entire empire on one final act: becoming the landlord of artificial intelligence. A $638 billion promise, stacked against a $120 billion debt pile. Genius or hubris? We'll know soon. This video is for education only, not investment advice. Subscribe for One Company Deep Dive every day. See you tomorrow.